Guys, listen up. Quit using your credit cards. Credit card debt is at dangerous levels and it's very scary for the economy. And here's what's about to happen next. You know we cover the economy. I've talked about it many times on this channel. But today I'm getting into the dangers of what that could mean with credit card debts at an all-time high. We are at record levels right now. Rapidly ballooning consumer debt can have a disastrous impact on individuals and not only that, the economy and all of us. Physical precious metals can help you safeguard retirement funds from the effects of runaway debt. And the danger of exploding credit card debt, it's becoming that more and more Americans are going to buckle under the weight of all that mounting credit card debt. If that's you, please listen up. Inflation and strong consumer spending has sent credit card balances ballooning. Again, I've talked about this. Outstanding credit card balances are now up an astounding $1.3 trillion. And I quote, over the past 2 years, American credit card balances have skyrocketed 40%. This is a quote by Ted Rossman, who is the senior analyst at Bankrate. The explosion of credit card debt could hold severe consequences for the entire economy, not just the people holding it, right? So it's not you, it's not me. What's gonna happen to you? The data points to credit card debt that is snowballing out of control. Credit card balances once again went up by 18% in November of 2023 alone. The share of people carrying balances month to month has leapt up to 49%. Only 1/3 of account balances are now paid in full, the lowest amount in 4 years. Meanwhile, 56 million Americans have been in credit card debt for at least a year. In addition to this, all stages of credit card delinquency, and I'm talking 30, 60, 90 days past due, jumped even higher in the third quarter of 2023. That's really scary to me, you guys. They surpassed the pre-pandemic levels and are close to setting a record high since data started being collected on this initiative back in 2012. Delinquencies are occurring as debt is getting drastically more expensive. Interest rates go up, debt becomes more expensive. Carrying a balance is worsened by sky-high annual percentage rates, which I just talked about, making the debt a deeper and deeper rabbit hole to climb out of. The average credit card rate is now more than 20%. Imagine paying that every month. And I quote again, most cardholders' rates have risen 5.25 percentage points during that span as a result of the Fed's rate hikes meant to combat inflation. This is another quote by Rossman. It's no wonder then that we're seeing more people carrying more credit card debt for longer periods of time. If you guys are just paying the minimum amount on your credit card rate with a 20% rate, that's brutal. You're just digging yourself a hole. The borrower is making the minimum payment on average credit card balances of $6,000, which is the national average of 20.74%, would be in debt for more than 17 years and end up paying more than $9,000 in interest on that alone. Now, the overwhelming effect of debt is feeding into the negative outlook that Americans have on the economy. This is despite being told how well the country is doing. To me, I look at credit card debt as a very key indicator. People are being forced to rack up debt for practical purchases, things you need like food, fuel, day-to-day living. They're not buying indulgences like luxury goods that can be delayed or totally ignored. Bills are becoming harder to pay in the face of stubborn inflation, burned up stimulus savings, and now renewed student loan payments. Banks are making it harder to get credit in response to all these delinquencies. So even if you got good credit, it's getting harder to get more. They're granting fewer credit line increases and reducing credit lines quite frequently. And even if the Fed does start cutting interest rates this year in 2024, credit card APRs aren't likely to improve very much. The bigger picture for the overall economy is that more credit card debt can be okay when things are going well. Now, consumer spending accounts are more than 70% of the US economy. We just use credit. It's what we do here in America. But the short-term boost can become a drag on the long term. If the current pace of defaults and delinquencies continue to rise, the consequences to individuals, financial institutions, and the broader economy, like us, is going to be absolutely profound. As individuals falter in repaying their credit card debts, the creditors, including banks and credit card companies, are going to bear the brunt of this. The surge in defaults would translate into significant financial losses for the creditors, aka the banks or the people lending out the money. Now, this could lead in a decline to their profitability, which potentially threatens the stability of financial institutions. Remember JP Morgan said bank stocks would rise this year? I don't know about that. As a response, these institutions might tighten their lending practices like we saw after '08, which creates a ripple effect that restricts access to consumers' credit. Now, consumer spending, which is a linchpin of economic growth, would contract as individuals curtail their discretionary spending. If you've got any goods that you sell that people don't need, your business is going to get affected by that. Now, businesses that are reliant on consumer spending would also experience a decline in revenue. Potential consequence here is that layoffs and a rise in unemployment rates compound the economic slowdown. Pretty simple math in my opinion there. The negative feedback loop could lead to a prolonged recession. I've said it for a long time. We're headed not for a soft landing, but for a full-blown recession. Investors holding securities that are backed by consumer debt would not be immune to the fallout. Asset-backed securities, including those comprised of credit card debt, form a significant portion of investment portfolios. A surge in defaults would exactly translate into losses for investors, which affects the investment portfolios and, of course, your retirement savings. So let's unpack this. What does this mean for Americans like you and I? The potential for massive credit card defaults presents an absolutely catastrophic financial danger, one we might not have seen in our lifetime before. Ballooning consumer debt could set up the economy for a very rapid and steep crash. This is what we've been predicting, and it's unfolding right in front of us. With overwhelmed Americans left with nothing left to spend and no credit to go out there and use, businesses are going to decline. Financial institutions could be left holding trillions in bad debt. Remember in 2008 when the bank stocks went way down because everyone was defaulting? Could happen again. Any government intervention could make the problem worse because stricter lending requirements would absolutely suffocate growth. Cutting rates could reignite inflation, while raising them could put the final nail in the coffin for everybody who has those sky-high credit card balances. That's not me. If it's you, be very careful out there. This is why experts are suggesting to look into precious metals. And you guys know I've talked about that many times on this channel. Greg and I mentioned them as a way to protect yourself from what could happen. They have no intrinsic value and no counterparty risk. Physical precious metals, especially when in a gold IRA, can protect the value of your retirement funds. And you all know this. I've talked about it many times on the channel. I hold gold and silver in my IRA for this exact reason. It's a very small investment. You can get as low as 5, 10, even 25,000. I've got much more than that in mine. But when you're holding that in your IRA and everything tanks, well, it goes up. It's just science, it's math. There's graphs out there. Look at the returns of gold, especially the market declines. This is the smartest thing you can do, and you've heard us talk about it over and over and over again. We're just trying to prepare yourself for what's ahead. I hold gold and silver. Greg holds gold and silver. I hold mine in my IRA, my retirement account. If you want information about that, there's a link below. We're out here trying to protect consumers. The credit card debts are absolutely ridiculous. I'm someone who pays mine every single month. I earn all the reward points, which are absolutely incredible. Thanks, Marriott. Thanks, Amex. Thanks, Delta. Thanks, American Airlines. But if you're someone who's holding a lot of credit card debt, especially with these rates right now, be very, very careful. And if you don't, tap yourself on the back because you're being very responsible and thrifty and smart with your investment. But if you're one of those people who worries about the rest of the people who are out there abusing credit, going out there buying Louis Vuitton even though they can't afford it, you might want to think about putting some money in precious metals, because when the crap hits the fan, they are going to rise and they hold their value no matter what. Stock market's really high right now. I don't think that's going to last much longer. Metals are the way to go if you want to play the safe card, especially if you're nearing retirement. Throwing even 5 or 10% of your portfolio into that could be a huge move that can help you not only get past this, but come out ahead. I'm Tim with Tag Economy. Stay tuned for more economic advice. Consider joining our newsletter. It's 100% free. We only send one email a month. TagEconomy.org. Thanks for watching. I'll catch you next time.